Paul, good to see you. Happy New Year, too. I imagine things are quite the buzz behind you there, as that number was quite the miss to the upside. Let's take a look at the data first and then reaction to it in terms of the indices, the treasuries, and the currencies. Look at that non-farm payrolls data. I mean, that was a huge miss to the upside. Paul, we're talking 312,000, well above the estimated 180. It looks like last month's got revised to 176. Unemployment rate, though, if you take a look, came in a little bit higher than expected. Let's take a look at that average hourly earnings. If we have that data, we can pull it up. You can see participation rate inched up a bit. But, hey, Paul, I imagine that the average hourly earnings and the sharp increase to the non-farm payrolls is why we're seeing the dollar rally and treasuries rally as well as rates rally as the treasuries come off.
Yeah, no, it was a huge groan on the floor when those numbers hit, and like you, we had to do a double take to make sure that was a 3 and not a 1 or a 2.
Yeah, I told him in the studio to double check the number.
No, absolutely. So, and the revisions higher are significant too. So it was a huge number. Participation rate picked up a little bit. So it is a big, big number. Wage growth now at 3.2% on a year-over-year basis. We're getting not toward the top end, but we're now above the midpoint range of that 2 to 4% wage growth number that we historically see, certainly above that 3% level that the Fed is looking at. And what's interesting is the markets have really taken off a Fed increase this year at all, and they're talking about a Fed rate cut late this year. And I'm sure these numbers are going to make that change those indications pretty quickly here.
Yeah, they are. Now, I think it's important to remember, Paul, that the first move isn't necessarily the real move in terms of a reaction to a big number like this. But I'm wondering, I noticed that we've got the treasuries, the 5-year, the bonds, the 10-year. It's interesting because, again, although they are reacting to the number, it's interesting because they still have yet to take out yesterday's lows.
No, that's true. And when you take a look at the bond market's really been moving off of the equity markets over the last 30 days or so.
Okay.
It was not the case early during the correction, but have been the safe haven buying. Also, there's now a lot more talk about a recession late 19, early 20, and I think investors are jumping ahead of that by buying the treasury markets and certainly going to the long end of the yield curve. We're getting a little bit of an inversion at the short end, but not a complete inversion of the yield curve yet to where that recession indicator flips on.
Paul, let's talk about the indices in terms of their reaction to, I'm noticing kind of limited. They're selling off a little bit. I'm curious. I mean, this shows strength in the labor market, which is reassuring considering some of the weak data that we've received recently. I mean, ultimately, this helps reassure investors. It'll be interesting to see if we actually get a lift from these numbers. I wonder if they're a little bit concerned, though, with the much higher than expected non-farm payrolls number coming in and the lift that we've seen in the wages as well, if higher rates is potentially one of the concerns that's starting to spark or come across the minds of investors at this point.
Yeah, and I think that's part of the reason why that knee-jerk reaction was to take about 100 points off the Dow right after the number was released, was exactly that, is now all of a sudden the Fed is back in play after being basically taken out of the picture for 2019. So, yeah, it's good news, bad news, if you will, but it certainly points to the fact that the U.S. economy is still running well and doing much better than the global economies, China, Europe, et cetera. So those are all bits of good news for the U.S. economy that we're still doing well here.
Yeah, you know, Paul, I'm looking at these ranges, 500 ticks yesterday in the Dow. We're talking about 50 handles in the ES yesterday. And I've got a chart up here, and I'm glad you pointed out that that was a 100-tick move in the Dow in reaction to this number, because if you take a look at the intraday charts here, the overnight levels, it really doesn't seem like much. It was kind of just a blip on the radar. We're smack dab in the middle of yesterday's range for the most part. You know, I was talking with our last guest about this, but I'm curious in terms of your thoughts on this. With the economy starting to show signs of cracks in the foundation, jobs are going to be closely watched, correct? I mean, so I'd imagine not only the monthly numbers, but in theory, some of the weekly numbers could become more important and more of a focal point as we head into the new year.
I think so, but I think, again, you're talking jobs, and it's true that jobs number tends to be the lagging indicator. Yeah. So when we start to see a tick up in job losses, or the unemployment rate starts to tick up because the economy is turning poor, we're already there.
Yeah, good point.
So you really want to take a look. Yeah, you want to take a look at some of the hard manufacturing numbers. Okay. You want to take a look at some of the even the weekly numbers. And really, when you look at the weekly jobless claims numbers, they're still very, very good. We're just off the lows of the last 50 years. So I'm not ready to say, yep, we're turning yet. A lot of the indicators that we look at are maybe flashing yellow. So the recession is a possibility still. We're not saying with any certainty we're going to run into one here just yet.
Hey, Paul, real quick, and then we'll let you get out of here. Gold up as rates have been coming off a little bit, but it's interesting because we've got the U.S. dollar, which is holding near the 2018 highs. I was just talking to Will Rind about this a little bit. What do you see moving forward here in terms of the dollar discussion as far as some of this activity and as far as rates and now this really strong number? I mean, where does that leave the U.S. dollar? Do you think we could potentially revisit highs now? Is this going to add some wind into its sails again?
Potentially it does. I think the dollar's been really in a trading range now since early November, between roughly 95 and 97.
Yeah.
And I think, it's come down as the data has weakened here a little bit. It's gotten a little bit of strength because of the employment report. But I think in general, I think we're looking for a little bit weaker dollar over the course of the year as our data softens up a little bit. And that will certainly help gold. Gold has really been the anti-dollar trade. So as the dollar weakens, gold should pick up a bit here. And I think that's really what we saw during the month of December. Yeah,
we've seen some of the other currencies that have been a little bit under pressure as well. We're talking the yen. The yen's actually been rallying. We were talking about some of the weakness we've seen in the Canadian dollar, the Aussie dollar as well. Hey, one more question for you. I'm curious, with treasuries, we've been seeing them rally recently. I'm wondering if stocks were to firm up, you think they would come off some, or is this just a flight to quality play that's going on? Or, Paul, are investors expressing their opinions? I mean, I guess I'm wondering if it's fear or investors telling us that that they don't expect another rate hike in the new year.
Yes and yes.
Okay.
So yeah, I think initially it's been the fear as the equity markets have come down. And then you take a look at what the expectations are for Fed funds going forward, those have come down as well. So you get really kind of a double bump from the treasuries, from a weaker equity market, as well as maybe a little bit weaker economic data or expectations for weakness in the economy later in 2019. I'm not sure if this data point reverses all of that, but I think it's something that makes certainly the economists sit up and take a look and maybe revise some of their numbers a little bit higher, and the GDP numbers maybe a little bit higher, 2% plus, as opposed to what I think the estimate's now running at 1.5% to 1.75% for GDP growth. And I think both of those should put treasuries on notice and maybe help out the dollar here a little bit as well.